Hello and welcome to Rethinking Insurance. I'm your host Anand Patel, and today we'll be exploring the dynamics of the specialty market, which is going through profound change between case underwriting and portfolio traded business. This podcast is inspired by our video series Thinking Unbound, in which we explore the latest trends and challenges facing the commercial and global specialty markets. If you'd like to watch the full video on this topic, please search for Thinking Unbound on our website wtwco.com. Today I'm joined by our guests, Will Archer-Shooter, Lewis Matthews and George Lewkowicz. Thank you for being here. I want to start by talking about the bifurcation within the specialty market. And people have used a lot of different terms around how the market is separating between case underwriting and portfolio underwriting, algorithmic underwriting, portfolio trading. There's a lot of concepts which are given to that other aspect of the market. And that seems to be a real growing area for insurers at the moment. First of all, what is your take in terms of what does portfolio underwriting mean, and what should insurers do to effectively trade in that particular market?
Yeah, so taking the first part of that question, what do we mean by portfolio underwriting? I think it's really a catch-all term at its broadest level, which could mean any distribution strategy or channel where underwriters aren't involved in individual risk selection. So that individual risk selection could be delegated to a third party, such as in a cover holder arrangement. It could be made by an algorithm that underwriters control in some of the algorithmic follow and algorithmic trading propositions. It could even be through a broker facility. So there's a number of those that have come into the market over recent years. But in all of those cases, what's really important is that the underwriters are assessing those opportunities against the strategic objectives of the firm. They're maximizing the capital allocation, and they have a really strong focus on portfolio management. You can kind of think of this as analogous to financial markets, where you have your expert stock pickers or you have funds of funds. Both of those ways of investing are seen as very good ways of investing, but there are different techniques, there are different skill sets under the two that are well respected. Maybe digging in a little bit further into what do people need to get right and what really improves your ability to underwrite in a portfolio manner is about having an understanding and clear set of strategic objectives. So are you entering into these portfolio channels to underwrite more premium? Are you seeing it as a way of accessing business that you don't already access? Or potentially it's to build a relationship with a broker or a third-party agency. And then you might want to think about what the types of business you're looking for. Would you like low volatility business with a consistent return? Are you happy to accept more volatility for a higher expected profit? There's no right or wrong answer to any of those, but having a clear understanding allows you then to build a well-articulated way and a well-structured way of reviewing the various different portfolio opportunities against those objectives. I think then it's about how do you assess your opportunity against those objectives and how do you continue to monitor those objectives, which means that portfolio management and portfolio monitoring come to the fore. You can't easily change your underwriting strategy through these third-party arrangements like you might be able to do when you're taking individual risk selections. So you need to have that much better forward-looking portfolio management view, be able to scenario test, be able to understand what that optimal portfolio looks like.
So I really liked your analogy in terms of how you can think of this in terms of the stock market and sort of the fund of fund kind of concept. So you're backing you've delegated your authority and you're backing a portfolio of business. Now it's clear that the market, it's already doing some of that through kind of some of the existing channels, like you mentioned, facilities, cover holders, but then we've got sort of new distribution channels from algorithmic trading, the digitization of the marketplace. So clearly that's an evolving area of portfolio trading. For those early adopters who've now started to embrace that distribution channel, what are some of the early challenges that they're currently facing?
Yeah, well, maybe I can take a bit of a stab at that from a digital perspective. So it's really interesting for me, this digital channel, because it's providing a way of accessing portfolios of business. It's providing, in many ways, a similar opportunity to your traditional portfolio opportunity, like a cover holder, like a traditional facility, but allowing insurers to have much more control over that per risk decision. There are many concepts that are similar to your traditional facilities. It's about strong portfolio management and being able to distill that portfolio appetite into an underwriting trading decision. But actually, the algorithms are giving insurers a little bit more control than they would have in a traditional facility or a traditional pure follow play.
Following on from that, so from a portfolio trading perspective, I imagine one of the areas that insurers are looking to benefit from is the lower expense base that's attached to underwriting on a portfolio basis. You don't have to hire underwriting teams. You don't have big kind of capital outlay in terms of infrastructure, technology, and therefore it should attract a lower expense base. How much of that is driving insurers' decisions to participate in this particular market versus it being more of a distribution play, an opportunity to expand their footprint? What are your thoughts?
It's a lot different to the traditional method of going out and writing these business. Your distribution channels are slightly different, and the expenses behind them are going to be different to what a traditional underwriting firm is likely to use. So there's particular nuances behind it that need to be understood to a greater degree, so that you can allocate those costs more effectively. Like there's been a lot of good practices built over the years for dedicated underwriting teams and small teams that are underwriting particular class of business. But then when you start to change the distribution channels and start to scale up even more, understanding the expenses and how they need to be allocated properly does become a lot more complicated.
I think maybe to add to that, we've talked about quite a lot of different distribution channels within the portfolio bucket. You could have opportunities where there is full delegation. You're getting good quality data in the same structure, the same format, monthly, weekly, daily, and you're able to process that very quickly, efficiently at a very low cost. On the other hand, you might end up in a arrangement where you're getting faxed information, PDFs that you have to cleanse, where you're actually having to do an awful lot of manual work in order to be able to ingest that data and make portfolio analytical decisions off the back of it. Well, in my mind, those two should very much attract different costs. But how do you set in practice a process that allows you at the underwriting stage to identify what opportunities should attract what expense loading? Historically, we've seen a lot of these opportunities written in individual lines of business and potentially getting the same expense allocation in some cases as the overall line of business, where you've got underwriters making individual risk selection. To me, that doesn't actually fully articulate the expense and the cost of writing some of these arrangements. They should be cheaper than open market business on an expense basis, but you want to have a good view of that cost.
As well as the expense allocation, how much do you think that should affect the price as well? If people don't have good control of their data and it's not set up in a way that's accessible, do you think that should be affecting the actual position on the technical price itself?
I think there needs to be certain considerations around it. I don't think it can be entirely ignored. Like if there's an opportunity that provides data in a better format, which ultimately results in less administration and less work, as you alluded to, you're not having to convert faxes into proper data structures. Those sorts of opportunities arguably should incur a slightly higher cost. But then that higher cost should then drive better practices in the future, so as to help keep the costs down. If you're going to attract higher expenses because your practices probably aren't up to market standard, then that could in theory be a driving force to putting the market in the right position to keep those expenses low, because ultimately your profitability and your combined ratio is going to depend on that. And if you're losing money because your expenses are too high, then you really need to start having those conversations and start to make those put in the actions to set those right.
Yeah, I mean, I can clearly see there's a big benefit from having more structured data, and there's a responsibility on all market participants to help drive that data structure and the conformity of the data that the market needs to use to be able to operate effectively going forwards. I think brokers have a really big part to play in that, in terms of helping drive the standardization of risk and the information that their clients are then providing, so that it becomes more optimized, and the market starts to receive some of the benefits from that, from the streamlining and digitalization process. I guess just taking that through a bit further. So obviously, data is going to be a really big aspect to the transformation of the market, and I imagine that a key part of that is therefore also technology. So in order to trade well in this particular market, what type of technology do you need in order to support it, and how has that moved on to support the carriers that are making inroads in this space?
I think the main changes that have happened, I say recently, we're talking over the last 10 years rather than the last 2, is the cloud. It's a very big answer, it's a very simple answer. But now we have the cloud. That means that your models can live in the cloud, and it means all that computing power is always accessible to you. I think we mentioned it earlier as well. The other major change is APIs. So if we have our pricing models in the cloud and they are accessible via APIs, suddenly that opens up how you call them, when you call them, how often you call them. If for a long time companies had these in spreadsheets somewhere, calling them and running them and changing them with a different set of assumptions was near impossible, or would take someone months or a good quarter to actually do the work. Whereas now we can get to the stage where we're repricing whole portfolios through a very simple API call and looking through which risks you've written and which ones you actually want to change. Maybe even daily. We've updated our inflation assumptions. We've got that through another API call. The API call has then happened to our models. Suddenly we've got a whole set of reprices for all of our portfolios that we're writing. And that technology exists now, has actually existed for some time. But the other really big change, and this is where WTW could help, is offering analytics as a service, actually joining all those things up together and having all those models so that they can talk to each other. It takes time, it's difficult. We've got to consider how all these different aspects can talk to each other technologically. That's not a simple thing. It's been made much easier, but now ready-made solutions exist, and those models already exist for you, and you can get something straight out of the box that works. And that is the bit that's changed really in the last year or 2.
And I think what's interesting there is when we talk about advanced modeling, advanced analytics, people historically, particularly in this portfolio space, have said, well, I don't have the data available, I can't possibly do any of that. But actually there are things that you can do. There are simple steps that you can take, even with a very limited data footprint, that help to give you a better understanding of the portfolio, to be able to do those make those portfolio optimization decisions that George was talking about, by making some changes to the underwriting process, by structuring some of that underwriting criteria and the underwriting data that you're collecting and feeding it into these models alongside the pricing that you're probably already doing. We actually see there's a huge amount of power and value in just collecting that data and feeding it into these models, at least as a first step before moving on to collecting more granular, more structured data.
And having those processes in place will also not only help you sort of set your optimization goals for what you want your portfolio to look like, but it also will help you have a better structure in understanding the drivers of your portfolio performance as well. So one of the main issues, potentially one of the main issues with portfolio underwriting is, you're doing it on a macro scale. You're looking at things from a top-down view, and it's really hard to get to get the particular nuances as to what actually is driving the underlying risks and underlying drivers of performance. So having this level of structure as well will help you allow you to dig into it a bit more, so that you can say, yeah, my overall loss ratio for my portfolio is 55%, but it's because of this factor, and it's because of this factor, and it's because of this factor, which will then ultimately allow you to make better overall portfolio decisions to move yourself into a better profitable position.
Well, thank you very much all for your insights. Clearly a fascinating area that the market's moving into. The technology, it sounds like it's already available. People need to start harnessing that technology and thinking about how they migrate and upscale their current capabilities. Thank you for joining us for this WTW podcast featuring the latest perspectives on portfolio underwriting within the specialty market. If you found this interesting, then please make sure to join us on future episodes of Rethinking Insurance.